Hey, what's up, Dividend investors? I'm Russ. This is Dapper Dividends, where we're talking all about generating income without selling our investments. And in this video, I talked with Cody from the Citizen of a Year YouTube channel, and we're going to each tell you about 3 stocks that we love that we're buying at the tippy top of our list heading into 2023. And we would always love to know in the comments below, what are some of your favorite stocks that you're going to be buying? Now, this is actually a two-parter where we've got Cody's picks on my channel, and then my picks are going to be on Cody's channel. So at the end of the video, make sure you click the link to get to his and to get my picks. And with that being said, let's get to Cody's picks.
Sounds good. All right. So first stock I have here is Medtronic. I'm sure you've heard of it before. It's a dividend aristocrat here. It's fallen on some pretty hard times here, but they're actually a leader in producing medical technology. They design, they develop, they're manufacturing medical devices for various healthcare industries. Russ, healthcare is one of those industries that's always popping. There's always going to be a need for medical equipment. And we're talking about surgical robots. We're talking about cardiovascular. Think about any pacemaker. Those are all designed, developed by Medtronic. And then anything going on with neuroscience, brain stimulators, diabetes, they make those blood sugar monitors. So really their products are used all around the world. I'm sure it's something that, you don't want to think about because nobody wants to think about.
Weren't they the first company to come out with the pacemaker?
I believe they were, actually. They've been around for a really long time. Been a public company for super long time, paying out dividends, been rewarding their shareholders. Very impressed with Medtronic here. And then, as I mentioned before, they're almost a dividend king. They actually have 45 straight years of dividend raises. So if we go to their dividend history here, you can see over time, they just continue to not only pay out consecutive dividends, but also raise them each year. Pretty amazing considering all the, different things that have happened in history, throughout the past couple of decades. But they found a way to continue to reward shareholders. So the reason why they've actually been declining in share price last couple of years here is that during C-19, a lot of surgeries were actually put on hold, right? Unless they were, life-threatening or elective surgeries, you probably wouldn't get the surgery done. There's so many resources that go into healthcare, trying to use those the most effective way that they can. So that really hurt them. They also do a lot of business in China, which has had some China's had some pretty intense COVID policies, which finally seem to be getting a little bit relaxed, latest that I've heard. There's also, of course, been widespread supply chain issues. So that's going to make their products a little bit more harder to assemble. And then the cost for supplies has also gone up. And then since they do so much business internationally, the currency exchange rates, those are all hurting Medtronic. So that's why you see pretty big decline in share price here, but that makes it more attractive for investors like us. If we look at the yield on cost or what it's been trading at historically, you can see that Medtronic this is probably the highest Medtronic has traded for in terms of starting dividend yield in years. Now getting around a 3.5% yield for a blue chip company like this, I think that's pretty impressive there, Russ.
Yeah, so that dividend yield is 60% above their 5-year average. So that's definitely something that is not very worrisome. And again, their free cash flow payout ratio only 73%. So that's a little bit high there, but yeah, I mean that's definitely something to look at.
Yeah, Russ, I've been adding into Medtronic almost on a weekly basis, now up to around 22 shares. So yeah, I'm loving this starting 3.5% yield because a couple of years ago, even before C19, I was buying them, when they were in the 120 range, getting like a 1.5% starting yield. And I thought that was good. So definitely loving this dip here.
Hey, how do you feel about do you feel more confident buying medical device manufacturers as opposed to like a biopharmaceutical company, given that, I mean, we're seeing with AbbVie that they're going to have the Humira patent cliff fall off here this year. So they're going to take a pretty substantial hit to revenue. I think I saw like 30%, over 30% revenue could take a hit with those biosimilars being able to manufacture one of their superstar drugs. And I don't know. There may be a little bit more sleep well at nightiveness to something like Medtronic because there's no patent cliff with their medical devices. And if they have that strong moat, then they should be able to maintain that. So how do you feel about medical devices over pharmaceutical companies?
Honestly, I like the best of both worlds. So I definitely invest in both. You know, I got AbbVie, I got Pfizer.
There you go.
So, you know, the thing is that big pharma is just so big that these big pharmaceutical companies, even if they do have, you know, a patent that's expiring, they can easily just buy out a competitor or buy a smaller company. And they're always just developing new, you know, drugs in their pipeline. So, you know, I understand that AbbVie's, you know, biggest moneymaker, that patent protection is expiring here in the short run, but it's just a matter of time before they get something else going on. And, you know, I know AbbVie just a couple of years ago, they merged with the company that makes like Botox, right? So now they have another big money maker. So that's what I expect these people at AbbVie to do. You know, AbbVie is right down the door from where we both live here.
Yes, they are.
But yes, can't go wrong with both the medical equipment companies as well as the pharmaceutical companies as well.
So that's one of yours, Medtronic. What else do you like about them? That it?
Yeah, I think that's a big one there. But no, Russ, the second company that I have as a huge buy right here is Google. Google is now down to, you know, it's 52-week lows. It has a ridiculous PE ratio of just 18, considering how high this company used to be back in the day. I feel like this is like highway robbery, buying Google at these prices. This is a company that brings in $250 billion in revenue. So when you are buying into Google, that means you're also buying into Google's absurd balance sheet of $116 billion. So we just talked about like mergers and acquisitions. Think about all the things that Google can do with this money.
Yeah, I was just looking myself because I talked about them that they have a antitrust ruling that they lost in September. Because I know there was something about, I was looking at investing into Google. Yeah, they had a $4.12 billion fine, but I thought there was, I don't know if you can speak to this. I know there was something about potentially their moat being hit in Europe. And I think that Google is going to be the next major company to initiate a dividend. Obviously, no prediction on when, but I think it's just a matter of time. So it's hard for me. And I get into this part about not buying something because they don't pay a dividend. There's no passive income, but obviously Google was on my radar, and I had come across a blurb that turned me off about them. So do you know anything about that?
I'm curious, is that for their search engine? Did they deem that as like a monopoly?
It may have been, and this is probably something, I should have been more aware of. But.
Yeah, I could tell you that 92% of all internet searches worldwide, they originate with Google. So, I mean, even if they did a small market share, they are just dominating this industry. And also, the two most visited websites in the world are, number one is Google, and then number two is YouTube, which of course we all know is also owned by Google. So that's pretty amazing right there. And then Google, they are basically an advertising company, right? They make a considerable amount of money from their Google ads, as well as from Google Cloud. And then I know you mentioned that they don't pay a dividend, and I know a lot of our viewers, they're going to get turned off by that. But Google, since they did their stock split, they're only trading now at $88. So $8,800, you can now do covered calls on Google. And that's actually what my goal is here. So I've been buying Google now almost on a weekly basis, getting closer to that number. And then honestly, I think sometimes covered calls, they might be even better than dividends, right? Like, you do kind of have to do the work yourself, but you can kind of, put more, you're kind of empowered to make your own passive income. You can set your own, strike prices, collect money on a weekly basis. Potentially with dividends, you only get them once every 4 or 3 months there.
So I will say, as somebody that's had quite a bit of experience writing covered calls and selling cash secured puts, at times it's been fantastic, and at other times it hasn't. So one of the problems is if you do weekly covered calls like I was doing with several companies, in particular Starbucks and JP Morgan Chase, is when we hit a period where it's been flat-ish and then there's a big market run up, and it just I couldn't catch up. So I had shares called away. And then this may be getting a little too esoteric, but point being that I did a video about Starbucks where I had shares called away at $82, And then it's all the way up to like, it was at 100-ish when I did the thing. So I would have been up about like 1,400 bucks or so had I not done anything with dividends received on those 100 shares that I had been holding. But, I don't know. I guess I've cooled off a little bit on covered calls because it kind of took my whole philosophy and thesis as things are right now is to generate income without selling stocks. And unfortunately, when your shares get assigned, meaning they're called away, you no longer have those and you have to try to buy back in. But do you have a lot of experience with covered calls?
Yeah, I have a decent amount of experience. You remember when the SPACs were the next best thing?
Oh, yeah.
Like early 2021. I was doing some
Yep.
options trading with Neo. And
Oh,
I
yeah.
actually made really good money at first. The thing is that I wish I had failed actually at those first couple attempts, because then I would not have went back for more. Because Neo was trading at like an absurd valuation, but the premiums were so juicy that, and I was a younger investor at the time, and I kind of got sucked into it. All right, so the first couple of weeks I was making like, nearly $200 a week for what I thought was kind of risk-free at the time. Cause everyone, Tesla was doing well. And then Neo, everyone was saying was the next Tesla of China. And then it only takes one really bad swing in the stock market or for that volatility to really show. And then like Neo went down like 20% in one day. And I was kind of left bag holding, still kind of am left bag holding. Neo is only a fraction of what it used to be a couple of years ago, but
it's under $10.
Yeah. So I can still do covered calls, but the premiums are nowhere near what they were, almost 2 years ago now. But, I think if you do them on, blue chip companies like Google here, and if you're more conservative, if you maybe go 30 days out, I think it can work in your favor. And, if we're only buying dividend companies, I think we are missing out on some potential gains with fabulous companies like Google that don't pay a dividend.
100% agree on that. Can't lock yourself into one system, and it limits your opportunity.
And just one last thing about Google here, Russ, is that maybe you don't believe us when we say that Google is as a buy right now, is that every quarter those that control over $100 million in assets, they're required to submit their 13F, which basically shows what the super investors, known as smart money, what they're investing in the past quarter. Google was actually the most commonly stock bought by 9 super investors. So they believe that the company is actually trading potentially 44% below its fair value. Now that's according to Simply Wall Street there. So smart money is buying into Google. I'm buying into Google. Again, I think these are some very low prices. We have to think about what Google will be in 10 years, right? Because we buy for future cash flows.
Yeah, I'm seeing this is alphaspread.com, and I'm seeing an intrinsic value of $97.93 for the base case, and then a worst case $67. Yeah, so in worst case, if they were to go negative for the next 5 years, they're saying about $67. And the funny thing about intrinsic value is to remember it's just a range there, because they gave $67.67 on that base case. It's just a range. It's kind of like knowing somebody needs to lose weight without knowing exactly how much they weigh. That's kind of how intrinsic valuation works.
Right. Yeah. I mean, there's no correct way to value something, right? If there was a correct way, everybody would be doing it. And then that way the stock market would not be working effectively there.
Yeah. All right. So what do you got? What's your next one? What's your third and final?
Russ, the next stock here is Ares Capital, ticker symbol ARCC. People need to be careful with the ticker symbol because there's several companies that sound very similar to this and also have similar ticker symbol there. So Ares Capital, they're going to be a company that kind of lends out money to these smaller and mid-sized market cap companies. Because they're kind of ignored by the traditional banking, right? It's harder to get funding when you're a smaller company, right? So there is a little bit more risk associated with Ares Capital, but there's definitely a lot of reward. And that reward is a 10% starting dividend yield, which is just mouth-watering there. So Ares Capital, the way that I think about it is like you're on Shark Tank, right? Like you are the shark, right? There's entrepreneurs that come in, they're wanting to, pitch their company, and the sharks, they take usually a small minority percentage, and then they provide their capital, and then the entrepreneurs, then they go out and use that capital effectively. So, and they also get to enjoy a piece of those rewards. So that's what Ares Capital is doing. They own hundreds of different companies. That's a small percentage into those different companies. They're getting interest back on the loans. They do get some, they get the equity, they get the returns. They're also really diversified in where they're located. The West Coast is 35% of their business. Midwest is 25%. They're really diversified in the sectors that they're investing in, with software services at 23%, healthcare at 10%. So really, Ares Capital, you would think with the 10% starting yield that, this is a company that has not been able to pay dividends during hard times, but that's actually not true at all. In fact, since they became a public company in 2004, they have paid a dividend every single quarter, which is, just amazing, because they also even paid a dividend during the 2008 recession. So how hard financial companies got hit during that time period. Ares was still able to pay a dividend each of those quarters, and they also continued this impressive streak even during COVID-19 here. So yeah, it is true that they have not maybe raised their dividend a good amount since 2004, but they have consistently been paying dividends. It has went in a slight upward trajectory there. So really impressed with Ares Capital here. I mean, you're not going to get much capital appreciation. They haven't done too much in the past 18 years, but a 10% starting yield when the typical S&P 500 return is 7 to 10%. That's why I'm buying into Ares Capital. It's one of the newer positions in my portfolio. Only recently been buying into them, but definitely one I'm going to be buying in 2023.
Yeah, what I like about Ares Capital too is that the bulk of their loans, they hold the first or second lien, which means that they're going to be first in line to get paid back in case there's a default. And what's beautiful about that, and I love what you said about them being like you could be the shark and like from Shark Tank. So they're helping these small companies that are trying to grow. But what I love is that yield is so high. And yeah, it doesn't grow a lot, but if you reinvest the dividends and buy more shares, you're going to keep growing that stream of income from these BDCs. And I think not all BDCs are created equal, but it's a time now in an environment we're moving into that is definitely going to favor the lenders and the savers. And obviously, you can't make any lending without saving. So I love it that we're saving money and putting it into a company that's lending out money. Like Ares Capital. And yeah, they're externally managed, right? So they're externally managed by Ares Management, which is like the big parent organization, which is a great external manager to have. And a lot of times you can get caught up in, these companies that have external managers. Like I think Prospect Capital was one where the CEO was just taking an absurd amount of money. And it was just almost like running a hedge fund at that point. And the investor was clearly second. But yeah, I think Ares Capital, I love that pick, man. I think definitely a solid company to invest in. And obviously, I do carry a little bit more risk. And I'm always going to say the higher the yield, the higher the risk. And you got to be compensated for that risk, but not a very difficult business to understand. Just and the special dividend, right? They've been 4 quarters in a row now. They've paid a special dividend as well.
Yeah, in case you needed even more reason is that you can get those special dividends every now and then. They haven't been too big. If I'm reading this correctly, it's a 3-cent special dividend. But, when they're paying out 48 cents a quarter on a $18 investment, that's pretty good. For me personally, I'm keeping this in my Roth. That way I can get, a little bit of tax shelter there and just continue to reinvest those dividends, continue to build that position. Hopefully they continue that 10% streak and it's going to balloon real quick.
Yeah, I love it, man. And I too will be adding to Ares Capital. When we recorded this, I reinvested dividends. I received dividends this week from Main Street Capital and from Ares. And I used those dividends to buy another share of each one. I probably could have done a little bit more with Ares, but yeah, I like it, man. Good picks. Good picks.
Nice. So Main Street Capital is another BDC you own?
That's another BDC, probably one of the biggest and best BDCs out there, ticker MAIN, and they're internally managed, really great management team. They've also been increasing dividends, not as high of a yield, I think 7.5%-ish, but yeah, those are the 2 BDCs that I did start investing in.
Nice. Yeah, I'm kind of newer to the BDC gang. of investing here, but I definitely am kind of intrigued. You know, I thought these were a lot more riskier, but I think since they own so many different companies that you're very diversified, and they do have very impressive histories of paying dividends. So that's what helps me sleep a little bit better at night.
Yeah, they're definitely, from everything I looked at. And again, a good book shout out is Stephen Bavaria's The Income Factory. Highly recommend reading that. Just breaks down all about BDCs, closed-end funds. He gets a little bit risky with some things out there, and that I'm not big on. But yeah, there you go. They're definitely nice portfolio composition.
I love how transparent Ares is with their holdings. Like, you can see exactly what they're investing in. You can Google all these companies yourself and see, like, hey, they actually do exist. You know, it's also even more information in their 10Ks. But I was shocked how transparent they were. I figured, like, private equity, you would kind of want to keep that to yourself or something, but it's not the case here.
Interesting picks from Cody that he had Medtronic, Google, which does not pay a dividend, obviously, and Ares Capital Corporation, ticker ARCC. And for yours truly's picks, make sure you click the box next to my head to get to Cody's YouTube channel and get those picks, and we will talk to you there.